So we talked a little bit about fear. Now let's talk about greed. Well, you're not greedy, right? No? Good. But sometimes greed or maybe the fear of missing out on something might be driving some behavior on you. It might not necessarily be greed for the greed's sake and a terrible thing, but it might be like, wow, everybody's making a killing in the stock market and it's really going up and technology is driving everything and I got to get in on this. And you might be thinking to yourself, is that the right thing for you at that particular time or the right amount of money you're investing? Or is it driven by, maybe something that might be greed a little bit? So understand that markets go up and down, and markets go up and down for a variety of real fundamental and technical reasons. Companies have better months than others or better years than others, and there's technical things there. There's business cycles. There's all sorts of stuff. There might be demographics behind it. Healthcare stocks might be rising because there's an aging population or there's a new drug a company announces, and that's driving up the price of its stock because there might be a new wonder drug that's going to really help that company earn a lot more money, and that'll help you if you're a stockholder in that company. But when markets artificially go up, especially as a large, big group, sometimes it comes from greed, and sometimes it's just from people piling in money and trying to get in on the train, so to speak, and sometimes they're getting in late. We see this over and over, and you might have heard the term FOMO, right? Or, a very modern term actually, fear of missing out, right? Fear of missing out. And you're going to work and your neighbor or your boss or your coworkers are saying, look at all the money I'm making in the stock market. Boy, I bought this stock and it's up this amount of money. And you're like, gosh, I'm missing out on this. I got to get in on this. And you're not looking at fundamentals. You're not looking at things. Or people might be using phrases like, well, this is the new normal. Stocks always go up 15% every year, year after year. That was like it was for a period of time in the 80s and particularly in the 90s. It was like that, with the internet, driving that. And that's when in 1996, Alan Greenspan, the chairman of the United States Federal Reserve, the person really in charge of the money supply in the United States, had a boring speech on about a bunch of different things, but he had this one phrase in there about irrational exuberance. You might have heard of that term. And it was basically that people are investing irrationally, and they were just so positive and exuberant about stocks and investing, because it was the internet age. It was the dawn of the internet, and you just invest in a company like Pets.com, and it'll go crazy, and you'll make a ton of money, and you don't even have to try hard. You don't even have to think. And that was the irrational exuberance. If you take the word separately, it was irrational. There was no rational thought or plan, and people were just exuberant for no reason at all. And that drove the market for quite a bit, especially during the internet. People thought, oh, this is a new normal. Everybody's going to make 15% or more on stocks. Well, it turned out 3 years later, actually, after Greenspan said this, wasn't right away. But then you had the big internet bubble, right? And the stock markets really crashed, gave up all their gains, and it was really, really a hard time. So if you hear these internet bubbles where it grows, and then the bubble pops, that's where everything then goes down real fast because it was based on greed possibly, or on fear of missing out, or irrational exuberance. Either way, people are getting in, maybe not for the most rational reasons. We recently had the Great Recession in 2008, 2009, with some financial aspects of that and the derivatives, but also the housing bubble, where things in the United States, particularly housing bubble, where drove prices up and then they all kind of came crashing down. So really understand that from your own standpoint as an investor, and this is where long-term investors, you kind of good to go back and think about fear and greed and think, am I investing? Am I changing my plan? Am I changing my behavior? Is it because I'm missing out, or maybe a little greed, or is it something else? So what to do if you have those feelings? One is, kind of like the fear part, right? Do nothing. Stay the course. Stay in the course, and having that systematic, regular plan really works. It's worked for me. I hope it can work for you too. Once again, we're not timing the market. We're not buying and selling. We're maybe long-term investors. Review your goals and plans. How is it matching up to where you want to be? Maybe you're getting a little toppity in some areas, and that can sometimes happen within where you might be, let's say, even if you're not greedy or you're not trying to invest too much, but your portfolio starts getting a whack. Maybe because everybody else is driving up stocks, your portfolio now, instead of being maybe a balance of 50% stocks and 50% bonds, just to keep it simple, might now have gone to 70% stocks and 30% bonds. And that's taking on more risk than maybe you wanted to at that period in your life. Maybe you're close to retirement, for example. So that's where rebalancing comes in, where you sell those winners, you sell those stocks, right? The whole sell high, right? Buy low, sell high. And you're selling those winners and you're buying more bonds, let's say, to bring it back in balance. And maybe you're buying those bonds when they're low, right? Buy low, sell high. Real Investing 101, to get back to the mix that you're comfortable with. Remember that 50-50 is your risk reward, your risk tolerance that you've decided on. So for somebody else, it might be always 70-30, but maybe they've gone to 90-10 and they need to bring it back into the balance that's right for them. Either way, you're rebalancing. And how you can rebalance, you can either just sell your winners, right, and then buy some of the lower performers and you get back in balance. Or one way I like to do too, to kind of ride those winners a little bit, if it's something that you feel comfortable riding a little bit and not incurring maybe transaction costs or taxes when you sell things, is to redirect my regular investments. I'm always regular investing. I'm always taking a percentage of my paycheck and regular investing, but maybe I change from buying 50% stocks and 50% bonds, I flip it to 70% bonds and 30% stocks, so I then inch up that bond to get back in balance as a particular example. Once again, your percentages will differ or may differ. So the understand that the key is, again, investing as a long-term gain, buying low and selling high, but when you have that greed thing, be mindful that you're not jumping into something because others are, particularly if it's something that's very speculative, or risky, and then that you're really following your plan and that you're staying in balance, that when things get artificially blown up like a bubble, so you can not be at as much risk that you are taking on of all that money coming up. So fear and greed really work together, and really understand those because they really drive the markets up or down. And really understand too, a key phrase is it's not about timing the market, it's about time in the market, right? So we're going back to that lesson one, that lesson two, where we're regular investing, compounding's working for us, maybe we're continuing to invest a little bit more, we're understanding risk and reward, and we understand fear and greed, and we're using that time to build towards our goals, and that's what it's really all about, while enjoying life today. So these 5 principles are real key things around that. Now the last lesson here, we've got a couple action steps, and then we're wrapping up.